Imagine holding an object in the palm of your hand, and depending on which way you tilt your head, it's worth two completely different amounts at the exact same moment. Logically, that makes no sense. An identical item should carry a single intrinsic value. A pound of gold in your left hand shouldn't suddenly be worth more than a pound of gold in your right hand. Yet this impossible contradiction is a real, measurable phenomenon. It happens every day, constantly, deep within the plumbing of global finance. Traders hunt for these glitches because they bypass the central risk of investing. While most strategies bet on what might happen in the future, finding two prices for the same asset allows you to bank a profit before anything has a chance to change. In finance, this pursuit has a formal name: arbitrage. Here is how it works. Let's say a specific stock is currently trading in New York for exactly $10. But over in London, that same exact stock is listed for $10.05. This 5-cent difference represents a mathematical certainty. Most profits require a correct prediction about the future, but this is a gain extracted entirely from the present, requiring zero speculation. There is a catch. This discrepancy is highly volatile. The market abhors a pricing error, meaning that 5-cent window only exists for an infinitesimal fraction of a second before the system corrects itself. Capturing that profit requires unimaginable speed. To exploit the window before it vanishes entirely, a trader essentially has to freeze time. If we conceptually stop the clock, we can look at the mechanical steps required to actually extract those 5 cents from the glitch. This diagram illustrates the absolute requirement of the trade: simultaneity. You have to execute the buy order in New York and the sell order in London at the exact same moment. If there is even a fractional delay between those two actions, you are exposed. Buy in New York, hesitate, and the London price might drop to $9.95 before your sell order goes through. Your guaranteed profit just became a sudden loss. Now compare that instantaneous requirement to how trading used to work. Human communication across distances involves physical actions, picking up a phone, speaking, reacting, which act as massive physical bottlenecks. Human reaction time is simply too slow. Flesh and blood operators are physically incapable of executing perfectly synchronized actions across oceans. To solve that limitation, markets transitioned. The physical exchange floors filled with screaming traders were eventually replaced by quiet racks of servers. Today, the modern arbitrager isn't a person at all. It is an automated algorithm written entirely to hunt for these fleeting mathematical discrepancies. These algorithms monitor thousands of global market feeds concurrently. They process massive streams of data to detect a 5-cent spread, orders of magnitude faster than human perception. Once the glitch is found, the algorithm fires. Perfectly synchronized buy and sell orders streak across the globe through undersea fiber optic cables, executing the trade in a matter of microseconds. Arbitrage has transitioned from a shouting match into a strict physics problem, locking in global profits before a human trader could even click a mouse. Multiply that single trade by thousands. There are legions of algorithms exploiting this exact same glitch, thousands of times every second. Watch this chart. In New York, massive automated buying increases demand, forcing the $10 price upward. Simultaneously in London, automated selling floods the supply, forcing the $10.05 price downward. When the two lines meet, the discrepancy is erased. The window slams shut. It is a built-in paradox of the market. The selfish act of exploiting the pricing glitch is the exact mechanical force that fixes it. The algorithmic hunt for these micro-discrepancies provides a specific structural service to the global financial system. Without this continuous automated enforcement, the global economy would be a chaotic landscape. You would have wildly varying, unfair prices, completely disconnected from an asset's intrinsic value. This ruthless microsecond hunt for free money acts as the invisible glue holding global finance together. By hunting down every discrepancy, these algorithms enforce the economic law of one price. They ensure that no matter where an asset is traded in the world, the markets remain perfectly and instantaneously aligned.